Have you ever noticed that the biggest fortunes in investing aren't made by the smartest people in the room, but by the ones who stay calm when everyone else is losing their minds? That's one of the greatest lessons from Howard Marks. While most investors obsess over chasing the highest returns, Marks has spent decades arguing that the real secret isn't making spectacular gains, it's avoiding spectacular mistakes. That simple shift in thinking has helped him become one of the most respected investors in the world. And by the end of this conversation, you may never look at the stock market the same way again. Howard Marks isn't known for flashy predictions or dramatic headlines. He's known for something much rarer: clear thinking. As the co-founder of Oak Tree Capital, Marks built his reputation by focusing on risk, patience, and psychology rather than trying to predict tomorrow's market. His famous memos have become required reading for professional investors because they don't promise certainty. Instead, they teach something far more valuable: how to think. Perhaps his biggest lesson is that risk matters more than returns. Most people ask, "How much money can I make?" Marks asks a different question: "How much can I lose?" Imagine two bridges leading to the same destination. One looks faster but has cracks you can't see. The other is slower but solid. Many investors choose the risky bridge because they're focused on getting there quickly. Marks reminds us that reaching your destination safely is what really counts. Protecting your capital gives you another opportunity tomorrow. Losing it means the game may be over. Another lesson that separates successful investors from the crowd is what Marks calls second-level thinking. First-level thinking is simple. A company announces good earnings, so everyone rushes to buy the stock. Second-level thinking digs deeper. Is the good news already reflected in the price? Are expectations unrealistically high? Could the market be overreacting? Great investors don't just ask whether something is good or bad. They ask whether everyone else already knows it. This naturally leads to another powerful idea: market cycles. Nothing rises forever and nothing falls forever. Bull markets create confidence that slowly turns into overconfidence. Bear markets create fear that often becomes panic. Howard Marks teaches that recognizing where we are in the cycle is more valuable than trying to predict the exact day the market will turn. Investors who understand cycles become less emotional because they know today's conditions won't last forever. That emotional discipline may be Marks's greatest strength. Markets constantly test our emotions. When prices are soaring, greed whispers that you'll miss out if you don't buy immediately. When markets crash, fear convinces you to sell everything before it's too late. Marks reminds us that emotions are expensive. The crowd usually feels most confident near market peaks and most fearful near market bottoms. Following those emotions often produces the exact opposite of successful investing. This is why Howard Marks frequently emphasizes being willing to go against the crowd. Buying when everyone is optimistic usually means paying high prices. Buying when fear dominates often means finding the best opportunities. That doesn't mean buying every falling stock. It means recognizing that panic can create bargains for patient investors who have done their homework. Closely connected to this idea is the concept of a margin of safety. Think of driving across a bridge designed to hold far more weight than your car. That extra capacity provides protection if conditions change unexpectedly. Investing works the same way. Buying quality assets at reasonable prices gives you room for mistakes, economic surprises, or temporary market declines. A margin of safety doesn't guarantee success, but it dramatically improves your odds over time. Marks also challenges our obsession with predictions. Investors constantly ask where the market will be next month or next year. His answer is refreshingly honest. Nobody consistently knows. Instead of relying on forecasts, he encourages thinking in probabilities. Rather than saying, "This investment will definitely succeed," ask, "What are the possible outcomes and are the odds in my favor?" That mindset reduces overconfidence and leads to better decisions. Finally, Howard Marks reminds us that patience is one of the most underrated investing advantages. In a world that rewards instant results, wealth is often built by those willing to wait. Compounding needs time. Great businesses need time. Even great opportunities require patience. The market often rewards discipline far more than brilliance. If there's one lesson that ties all of Howard Marks' wisdom together, it's this: investing isn't about proving you're smarter than everyone else. It's about making consistently good decisions, managing risk, controlling your emotions, and staying patient while others chase excitement. Because in the end, the investors who build lasting wealth usually aren't the ones who swing for the fences. They're the ones who stay in the game long enough for time, discipline, and sound judgment to do the heavy lifting.